What is a non-QM loan? Hey guys, my name's Andrew Augustiniak from the Augustiniak Lending Team. And the word non-QM and non-QM loans have been around, but they haven't been as popular in the past as they are now. What is a non-QM loan? A non-QM loan is a non-qualified mortgage. Essentially, it's the opposite of a conforming loan, a conventional loan. A Fannie Mae loan. Non-qualified mortgage is basically a unique type of loan. I'm trying to explain this in ways that you would understand, not just mortgage people. But let's say somebody is self-employed and they write off all of their income, which is what most self-employed people do. They make money, they have expenses, they pay taxes on the net minus their expenses, so they limit their tax liability, which is what a smart business owner should do. But when it comes to qualifying for a mortgage, that may be tough because for traditional financing, we have to look at what they actually claim as income and what they pay taxes on. So a lot of self-employed people, you go down to the bank, you might get denied because the bank only goes off traditional, simple, vanilla loans. So here comes the non-QM loan. The non-QM loan is the, we'll call it creative type of financing. That is still a traditional, 30-year mortgage, 15-year mortgage, but the avenue to which we qualify that client for a loan is different. So on a traditional mortgage, we go off the tax returns, pay stubs, all that fun stuff. Self-employed person doesn't have that and they get denied for a traditional loan. On a bank statement non-QM loan, it's kind of more common sense for their situation. We might go off, there's multiple different avenues to qualify, but let's say we use the 12-month bank statement loan. We're going to look at 12 months of that person's business bank statement, maybe their personal accounts, hopefully they're depositing in their business account, but we're going to look at 12 months. We're going to take the actual revenue. That's what happens a lot of times when I talk to self-employed people. They say, hey, I make $500,000, but on paper, I only show the government $80,000 because of my expenses. Well, on the non-QM loan, we're actually going to look at that $500,000 in income. We're going to hit them with a small expense ratio, usually 25%. And that's what they're going to qualify for. So somebody, let's say they had $80,000 in income on a traditional loan. That's, what is that, just $7,000 give or take in qualifying income, but their business makes $500,000 a year. On the bank statement route, they're going to have $35,000 give or take, $35,000 to $38,000 give or take in usable income to qualify. So that route provides an avenue for them to get financing, traditional 30-year financing, but just in a different way of qualifying. Downsides to any of this program. Usually you might have a slightly higher interest rate, you might have slightly higher fees, but that's the cost to a more aggressive form of lending of how to qualify for a mortgage. So non-QM financing can be bank statement loan. It could be a 1099 only loan where they don't go off the net after you have your expenses. It might be a P&L only loan. It might be a investor DSCR loan. And that means that for an investment property, there is no qualifying. There's no bank statements even. All you're doing is qualifying off the market rent for that property. Okay, so there's so many different avenues of qualifying for a non-QM loan. Non-QM loans have basically doubled and tripled the amount of what we're seeing in the market just in the past 5 years alone, but they've always been around. So if you guys have any questions on non-QM loans or anything involving non-QM or just weird financing, feel free to shoot me a DM. Please make sure to like and subscribe this video as we try to grow this fun little channel, and we'll catch you on the next video.